Hey guys, welcome to the next episode of Audit Practically series, and I hope you all are doing great. So I'm also doing great. So today we're going to be looking at how an audit firm recognizes revenue. So guys, almost 90% of us we have done our articleship in an audit firm, and we have also done stat audits. Have you ever wondered how the firm in which you are doing our articleship recognizes revenue received from clients as audit fees? Guys, today we're going to be discovering the answer to that question. So sit back, relax, and enjoy as we dissect and deep dive into this, guys. So what are you waiting for? So guys, so right now, after I reveal this topic, you would be having some questions running right inside your head. So let me break down each of these questions. So the first possible question being, should the revenue recognition be on POC or your point in time basis? Guys, in 95% of the cases, if you have to give you a single line answer, it would be on POC basis. In the remaining 5% of the cases, it would be on point in time basis. And guys, but you would have a doubt right now. In the description of the video, in the thumbnail of the video, I mentioned that I'm going to be correlating Ind AS 115 with this. But sir, in India, most of the audit firms are either partnership firms or LLPs. In India, an audit firm cannot be in the form of a company organization, and Ind AS only applies to company organizations that exceed a certain threshold. Guys, you're absolutely right. Yes, we need to look at AS9. But as you all are aware, AS9 just says only one line about revenue recognition in relation to services percentage of completion. It only states that there is a method called proportionate completion method where revenue has to be recognized as and when the services are completed proportionately. It does not say anything beyond this. So from my practical life experience, where I've seen clients usually apply what is said in AS9 in relation to percentage of completion in services. Along with that, they also apply the guidance stated in Ind AS 115. So they apply Ind AS 9 and AS9 and Ind AS 115 harmoniously. So that is how revenue recognition works in real world, even in an AS client. I hope that is very clear, guys. So we would have to go into Ind AS 115, understand its nuances, and apply the same even in our audit firm. I hope that is very clear, guys. Yes, but in remaining 5% of the cases, the revenue recognition would be on a point in time basis, guys. So the simple one line answer is 95% of the cases it's percentage of completion, 5% of the cases it's point in time. So before coming to a conclusion on how in 95% of the cases it is percentage of completion, let us understand what Ind AS 115 has to say in this regard, guys, and let's then come to a conclusion, right? Yes. So para 35 of Ind AS 115 talks about this, guys. So what does para 35 of Ind AS 115 say? So I'm just presenting my screen for you to read up. I'm not going to go into this in a very elaborate manner, assuming that you all know Ind AS 115. I'll just do a quick recap of this so that you're able to recollect it and reignite it in your memory. But I'm not going to deep dive into this. So guys, first, the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. So basically, in this case, for criteria A, what the standard is trying to say is that if the customer is simultaneously receiving the benefit as and when the entity performs, like let's say in the example of your security services, like let's say when the security performs the services, or in case of payroll processing services, whenever the entity performs the services, the customer is simultaneously receiving the benefit. So guys, before I proceed further, there are three criteria mentioned here: criteria A, criteria B, criteria C. Even if one of these criteria is satisfied, you can recognize the revenue using percentage of completion method. So like as I said earlier, in case of your payroll processing services, your criteria A would be satisfied, or even in case of the security services, your criteria A would be satisfied, and hence percentage of completion method would need to be applied. I hope you understood this. But let's take the audit service here, which we are discussing about. You are providing audit service to a client. When would the client receive the benefit? Only when you sign the audit report, because only when you sign the audit report will the client be able to file the audit report and the financials with the ROC. Am I right? Yes. So the client does not receive the benefit simultaneously. The client receives the benefit only when you complete the audit and only when your partner signs on the audit report on the dotted line. I hope that is clear. So criteria A is not satisfied for audit services. I hope it is very clear, guys. Next, coming to criteria B. Entity's performance creates or enhances an asset. For example, work in progress that the customer controls as the asset is created or enhanced. So what they're trying to say is the entity's performance creates or enhances an asset. Let's say usually in case of construction contracts. But does it happen in the case of audit? No, because in audit we are providing a service. We are not creating or enhancing or constructing an asset. We are just providing a service which does not create an asset, because a service is intangible in nature. A service is not tangible in nature. I hope that is clear. So criteria B again is not satisfied. So till now we come to a conclusion that POC is not appropriate. So we need to look at criteria C. If criteria C passes, then percentage of completion method can be used for revenue recognition in audit. I hope that is very clear, guys. coming to criteria C. Criteria C. What does criteria C say? The entity's performance does not create or an asset with an alternative use to the entity, and the entity has an enforceable right to payment for the work completed to date. So what does this mean, guys? So what they are trying to say is in criteria C, there are two sub-criteria. So both these sub-criteria need to be satisfied for criteria C to be satisfied. And if criteria C is satisfied, the audit firm can recognize audit services based on percentage of completion method. I hope that is very clear, guys. So first one, the entity's performance does not create an asset with alternative use to the entity. So what they are trying to say is, let's say you are a seller entity and let's say you are creating an asset for a particular entity, and let us say that asset has alternative use. Let's say you're not able to use it with regard to customer A, but you, the seller entity, are able to use that asset in customer B, then the asset is said to have alternate use. Does that apply to audit? No, guys. In audit, we are not creating an asset. We are merely providing audit services, which does not involve any creation of asset. So the first sub criteria is satisfied because the asset does not have any alternative use, because an asset is not even created in the first place. I hope that is very clear. Next, and the entity has an enforceable right to payment for performance completed till date. Guys, so Ind AS 115 clearly states what is enforceable right to payment. So Ind AS 115 states that enforceable right to payment should be assessed at the inception of the contract. This is very important. It should be assessed at the inception of the contract. And enforceable right to payment means the payment for the work completed till date. And that payment would usually be the cost plus a reasonable margin which the entity charges. Let us say for your audits, usually you charge cost plus 10% from other clients. But let's say in the engagement letter that you have entered with your client, you have said that if the audit comes to a standstill or if the audit is halted on account of the client's incompetence or the client's fault, you would charge cost plus maybe 5%. In such a scenario, you don't have an enforceable right to payment because the profit margin is not reasonable or is not in the ordinary course of business, because you ordinarily charge a margin of 10%, but here you're only charging a margin of 5%, which is not reasonable. I hope you got it, guys. And let us say in the engagement letter you entered with the client, you are saying that the audit comes to a halt because of the client's inefficiency. You would only charge the liquidated damages to the extent of 10,000. In that case, do you have an enforceable right to payment? No, you don't have an enforceable right to payment. And in that case, your criteria C would not be satisfied, and you would have to recognize revenue only at point in time because one of the sub criteria is not satisfied. Remember, guys, in criteria C, both the sub criteria of asset does not have any alternative use and the entity has enforceable right to payment, both these sub criteria need to be satisfied to have to recognize revenue via percentage of completion. I hope that is very clear, guys. Next, just coming down. So this is what I said. So for criteria A, to ascertain whether the entity simultaneously receives and consumes the benefit, there are a couple of sub conditions that we need to check actually. So which is not very relevant from our audit discussion, audit revenue recognition discussion. I'm just written it down below. In case you want it, you can just refer it. I've anyways given the link to my Telegram group below in the description and in the first pinned comment. You can click that and you can find this PDF here. But if you want me to explain this from an exam standpoint, I can definitely do that in a separate video. But I don't want to be doing this with the audit video because I don't want this video to get too long and I don't want this video to be like very long and monotonous. I wanted to make this as interesting as possible and stay as relevant as possible to the point, right? I hope that is clear. So criteria C elaborated. So this I had just explained. So like asset has no alternative use to the seller entity. I just explained the example where let's say I am able to the seller is able to use the same asset for customer B. In that case the asset has alternative use. Let's say in the contract it says that the customer has to only use the asset for customer A. Then the asset has no alternative use to the seller entity. So this is from the standpoint of the seller entity. That is the entity which is going to recognize the revenue. I hope that is clear. And I already explained what is legally enforceable right to payment, and when you don't have a legally enforceable right to payment, I've already explained that. It is just highlighted here. I've already explained that there is no point which I've compromised here in the legally enforceable right to payment. So as I told earlier in this example, like this is actually a question from your ICA study material, which I just explained while speaking. You can again go through this. It's a good question. Again, we have evaluated the criteria and we have come to a conclusion that if criteria C is satisfied, that is where the asset has no alternative use, which obviously it won't have because audit is a service, it is intangible in nature, it does not lead to any creation of asset, and if the entity has enforceable right to payment. So having an enforceable right to payment is the heart of the scenario here. So that you have to understand by looking at the engagement letter which the audit firm and the audit client enter into basis SA 210. I hope that is clear. You need to do a detailed scrutiny of the engagement letter, see whether the entity has enforceable right to payment by looking at the profit margin, by looking at the clause mentioned, And in 99% of the cases, there will be an enforceable right to payment because the audit firm would clearly want to indemnify itself. So in 99% of the cases or 95% of the cases, the revenue recognition would be on a POC basis for audit services rendered by an audit firm to its audit clients. I hope that is very, 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 very clear, guys. Next is coming down. So let's say a contract, that is engagement letter, does not have an indemnification clause. In such a case, it would be a point in time revenue recognition, or the indemnification clause says that a standard amount of 5,000 would have to be paid by the client to the audit firm as a liquidated damage. Then again, it would be point in time as we had earlier discussed, because you don't have an enforceable right to payment. You're not charging cost plus reasonable profit margin. I hope that is very clear, guys. Next. So methods. So next. So for measuring your percentage of completion, there are two methods, guys. One is your output method, other one is your input method. So in your output method, this is usually used in case of construction services, because in output, like what do you usually do in case of percentage of completion? You take the actual cost incurred till date divided by your total expected cost, and you arrive at the percentage of completion, and you multiply that with the contract value, right? But you can't do that in case of construction services. The reason being, let's say there is a building construction. Let's say it's a 5-floor building. Let's say one floor is constructed. Let's say the ground floor is constructed. Remaining 4 floors are there. You cannot say that 20% of completion is done, because in this scenario, in a building, the heart of the building is its basement. The toughest part in a building is laying the basement. So the percentage of completion would not be 20%. It would be 30% or 35%. That has to be certified by a valuer. You cannot merely come to a conclusion saying that since I've completed one floor, it's 20% of percentage of completion. No, you cannot say that, which is why you require a surveyor. In your audit services, it would be an input method that would be used and not an output method. And there is a practical experience which they have stated in relation to output method, guys. What is this? Let us say I have a right to bill rupees 100 to the client today as a construction contractor, and I can recognize 100 of revenue today itself. But what they are saying is this shortcut, basically practical experience means a shortcut, as you are aware. So this shortcut has to be applied to all contracts. Let's say I have a right to bill rupees 100 from customer A today, and let's say I have a right to bill rupees 80 from customer B today. But let's say in relation to customer A, I apply the practical expedient and recognize revenue of 100. But in relation to customer B, I call for a surveyor and tell him to come and assess the percentage of completion. No, I cannot do that. If I'm using the practical expedient, that is a shortcut for customer A, I need to use that shortcut for customer B also. I hope that is very, very clear, guys. I'm not going really detail into this because this is not very relevant from our audit services discussion, but I'm just touching upon it slightly so that you are just able to recall what you just studied some time back in relation to Ind AS 115. Next, input method. This is really important for us. So revenue recognized based on entities, efforts, or inputs relative to the total expected inputs. Example, resources consumed, labor hours expended, machine hours used, cost incurred. So in our case, the labor hours would be the input which we would be looking at right now. Because in an audit firm, there is a concept called charge out rate, which we will be discussing, basis which the percentage of completion is arrived at. I hope that is clear. Next. If entities, efforts, or inputs are evenly there throughout the performance period, recognize revenue on a straight line basis. So for this, I earlier gave you the example of the security services, guys. I'm not sure if you're able to recall the same. So security services, day in and day out, it's the same 8 hours of work which the security agency is rendering to you. So let's say the contract is for 12 months and 1,20,000 is the contract fee that is agreed. So on a monthly basis, you would do 1,20,000 of the contract amount divided by 12 months. Rupees 10,000 per amount would be the amount you would recognize. So what the standard is saying is, boss, don't break your head over services that are consistent over a period of time. Just simply do a straight lining, like how you do your straight line method of depreciation, and recognize the revenue over the period of time. Don't break your head too much. That's what they're trying to say. I hope that is very clear, guys. Next, and change in the method, like let's say you were earlier using input method, now we want to change to output method for arriving at the percentage of completion. This is a change in accounting estimate as per Ind AS 8, and this has to be done on a prospective basis as per Ind AS 8, because your accounting estimate would have to be done on a prospective basis and not a retrospective basis, because this is due to change in facts, and your change in facts cannot be backdated and affect your previous years. I hope that is clear. Next. So in our input method, we do revenue recognition in the below manner. How do we do that? So basically, your revenue to be recognized in a financial year would be total cost incurred till date by total estimated cost to be incurred, which would give you your percentage, into transaction price, which would give you your cumulative revenue to be recognized. Let's say when I do total cost incurred till date by total estimated cost to be incurred into transaction price, I get a number of 120. Let's say the revenue recognized till date. Let's say the revenue recognized in the project across all the years put together comes to, let's say, rupees 80. So 120 minus 80, rupees 40 would be the revenue I would need recognized in the current financial year. So you would be applying this concept in your Ind AS 115, in your Ind AS 102 share-based payments, and you would have even applied this in your CA intern AS7 construction contracts. I'm sure you would be familiar with this. In case you have any doubt in this, do comment that down below, and I will do a separate video on this. Right? Next. And by applying input method, certain costs need to be excluded, guys. So there is a very, very beautiful illustration in your ICA study material in relation to a lift contract where a company constructs a lift and installs the same. So you can check out the illustration. So there are certain costs that need to be excluded. You will get clarity while checking out the illustration. Anyways, in my notes below, I have included that also. And as I said earlier, I am attaching the notes PDF in the Telegram group. You can check this out if you want. And if you want an exclusive video on this, you can comment that down below. I will do a video covering these points on which costs have to be excluded in a very, very elaborate manner. But I want this to be an interesting video, an insightful video, which is why I'm not touching every single aspect in Ind AS 115. I hope you're able to understand and relate that. Next, if I just come down. And just before we proceed with the discussion, just want to tell you to keep one thing in mind. So one simple point is that, let's say there is a labor inefficiency. Let's say 100 hours were required to be spent on a job, but 102 hours were required to be, but 102 hours were spent. The 2 hours of inefficiency which was spent should not be taken into account for percentage of completion. Just keep this point alone in mind because we'll be later coming to this point at some point of time, right? I hope that is very clear, guys. Next, let's get back to our discussion. Now let's get into the real game, guys. We were just seeing how it is percentage of completion and why it is not point in time, but now we have come to a conclusion that it is percentage of completion in 95% of the cases, and now we're going to be taking real numbers, guys, and we're going to be coming to the same. So yes, just let's just come down, right? Let's say PwC is engaged to conduct the audit of XYZ Limited for finance year 24-25, guys. So let's say the audit fee is rupees 30 lakhs for financial year 24 for the audit of financial year 24-25. Let's say the condition C is satisfied. Like that is an audit that is an asset with already use is not created, and that PwC has an enforceable right to payment with regard to XYZ Limited. Both these conditions are satisfied, so we will be recognizing revenue via the percentage of completion method. I hope that is very, very, very clear, guys. So let's say PwC started some interim work on March 15, 2025 itself. Why do firms do this? Because they don't want any last minute hiccups towards the closure of the audit, which is why they try to start the audit a bit early itself. So let's say they started the audit around somewhere around March 15, 2025 itself, and they plan to do things which can be done before the year end itself, like vouching, like your sample verification. Why can your sample verification be done before the year end itself? Because your 11 months up to February are over. So you can select your operating expenses samples, you can select some payroll samples in these 11 months and vouch them, right? And in inventory count, you would do that in March, ideally on March 31 itself, because you would want to match the same with the book stock and get comfort on the same, right? I hope that is very clear. Next, how would PwC recognize revenue in their books of accounts? Before that, I just want to tell you one more information. Billing milestone. What is billing milestone, sir? Billing milestone basically means you agree a date on which a particular amount will be billed. So in this case, as I told you, the total audit fee is rupees 30 lakh. PwC says to the client, that is XYZ Limited, that sir, on 31st March, I will raise an invoice for rupees 5 lakhs, and on 30th September, that is the day on which I will be signing the audit report tentatively, I will raise an invoice to the extent of 25 lakhs. So it is a progressive billing in this case, guys. I hope that is very, very, very clear. So first we need to find out the percentage of completion, because we have concluded that condition C is satisfied in our case. Let's just come down, guys. Before that, let's just understand the concept of charge out rate. I hope that is clear. So before, let's just understand the concept of charge out rate, guys. So basically, what is charge out rate, guys? Charge out rate basically means the rate at which every resource would be assigned. So what would happen is, let's see the hierarchy in any audit firm. There would be a partner, there would be a manager, there would be an associate who would be usually a recently qualified CA or a CA with like 1 or 2 years of post qualification experience. Then there would be an article who would be undergoing articleship as per ICA norms. So these should usually be the people in an audit engagement team, right? So what would usually happen is, every firm, while proposing an audit fee number to the client, they would compute the cost that would be incurred. So they would assign a rate per hour to each of these resources depending on their capabilities. So obviously the partner would be assigning the highest rate because the partner is the most experienced person in the audit engagement. And the partner is one of the most valuable resources because he's the person who's signing, he's the person who's taking responsibility. So he would have the highest charge out rate. So this charge out rate is usually computed, guys, on the basis that every audit firm like has operating expenses. Like every firm has rent cost to incur, every firm has depreciation cost to incur, every firm also has other internal costs to incur. So they will try to recover these internal costs through audit engagements. So they will take those internal costs into account. They will also take the salary of each of these people into account, and they will arrive at a rate per hour which will be standard. And they would assign this rate per hour to the engagements. So if I just come down, guys, so if you see, the hours budgeted for a partner is 36 in the engagement, for the manager it is 180, and for the associate it is 228, and for the article it is 450, and for the partner it is 10,000 per hour, for the manager it is 5,000 per hour, for the associate it is 2,000 per hour, and for the article it is 1,000 per hour. So if you arrive the total cost expected for each of these people, for the partner it would be 36 into 10,000, rupees 3,60,000 would be the expected cost for the partner in relation to Audit of XYZ Limited. Similarly, for the manager, it would be 180 hours into rupees 5,000 into 500 hours into 5,000 per hour. Rupees 9 lakh would be the total expected cost on this engagement. And for the associate, it would be 228 hours into rupees 2,000 per hour, rupees 4 lakh 56,000. Similarly, for the article, it would be 456 hours into rupees 1,000 per hour, giving a total of 4 lakh 56,000. So if you see the total cost that is expected on the engagement, it would come out to 21 lakh 72,000. And which is why obviously PwC has agreed on a fee of 30 lakhs, which is over and above their cost, and which is obviously a reasonable margin. I hope that is very clear, guys. Next, how do we compute the percentage of completion here, guys? Let's say as at March 31, 2025, 92 hours are booked. But just keep in mind, guys, out of these 92 hours, 2 hours are booked extra by an article due to inefficiency, because the article assistant is obviously new on the job. He would have to get an understanding of the client. He would have to discuss with seniors. He has spent 2 hours in getting some knowledge transfer or some other inefficiency. Let's say he has booked that time also. So that time should not be considered for the purpose of percentage of completion. So if we just come down here and see the breakup of the 92 hours, 40 hours have been booked by the associate, 42 hours have been booked by the article, 8 hours have been booked by the manager, and 2 hours have been booked by the partner. So that adds up to 92 hours. But while doing the percentage of completion, we have to take the hours booked by the article to be only 40 and not 42. I hope that is clear. So when we arrive at the total cost incurred as at March 31, it would be as follows. So for the associate, it would be 40 hours into 2,000 rupees 80,000, and for the article, it would be 40 hours into 1,000 rupees 40,000, and for the manager, it would be 8 hours into rupees 5,000 40,000, and for the partner, as we saw, it would be 2 hours into 10,000 20,000. So if we put all of these together, we get a cost incurred till March 31 to be 1,80,000. So now we need to get the percentage of completion. So basically the percentage of completion would be 1,80,000, that is the cost incurred till date as at the financial year end, divided by 21,72,000, because 21,72,000 is the total cost that the firm expects to incur. So it would basically be 1,80,000 by 21,72,000 into the transaction price, which is 30 lakhs. So basically we get a percentage of completion number of rupees 2,48,618, guys. I hope that is clear. So ideally, 2,48,618 is the number which should be recognized as revenue by the audit firm. And let's say you are the auditor of the audit firm. How would you get comfort on the number of 2,48,618? Let's discuss that as well, guys. As I told you earlier, the rate per hour is standardized. You cannot do much audit procedures surrounding that, but you can do audit procedures regarding the hours that have been booked by the engagement team, because usually audit firms have timesheets, and using the timesheet you can check the accuracy of the hours that have been provided to you, and you can match the same with that, and you can get a comfort that the hours are reasonable. And similarly, you can understand from the engagement manager by sending a mail to the engagement manager. As an auditor of the audit firm, you can send a mail to the engagement manager of XYZ Limited, that is the manager of PwC who is working on the audit of XYZ Limited, and ask him the progress as on March 31. Let's say he tells that your vouching to a decent extent has been done, and let's say your stock count has been done, but no area has been completed fully. But let's say the percentage of completion comes somewhere around 20%. That is alarming, because only vouching has been done and only the stock count has been done. So the percentage of completion should not be anywhere more than 10%. So if it is 20%, it is something alarming. So in our case, if we saw, it is coming to 8.28%, which is very reasonable. So it is based on professional judgment. So you get a bit of comfort that okay, it has to be somewhere around 10%, and it is at 8.28%, which is reasonable. So I hope this is clear. So as an auditor of an audit firm, you can get comfort on this number through this. I hope that is clear. Okay, guys. Let's look at the entries in PwC's books for financial 24-25. So the first entry that would be passed is contract asset account debit 2,48,618 to revenue 2,48,618. Let's say this is the entry they would pass on the morning of March 31st, 2025. And let's say the invoice is raised in the evening of March 31, 2025. What entry would they pass? They would pass the entry XYZ Limited debit 5 lakhs, because they are raising the invoice to the extent of 5 lakhs, and they have receivable from XYZ Limited, who is the audit client, to the extent of 5 lakhs, to contract asset 2,48,618. They are reversing the contract asset, because for a customer you can only have a contract asset or a contract liability. You cannot have a receivable and a payable against the same party. So this concept I have already explained as a part of Audit Practically series in PPE videos and Accounts Payable videos. You can click the information button or the description of the video to get links to these videos and understand the netting of we do So you basically reverse the contract asset balance to the extent of 248,608. Then you recognize the contract liability to the balancing amount, which is 251,382. 251,382. I hope that is clear, guys. So what would happen is, so if I see here, the contract asset is entirely knocked off. So only XYZ limited balance is coming to here. So what would happen is this XYZ limited balance of 5 lakhs would be shown under trade receivables in your financials, and the revenue would be taken to P&L to the extent of 248,618. I've shown this as two different entries for you to get an understanding. Guys, you can just combine this and write a compound entry. That's perfectly fine. And the contract liability would be grouped under other current liabilities in your financial statements. I hope that is clear, guys. This is the first scenario, very ideal scenario. Let's take the second scenario. Let's take an unideal situation. Let's say PwC was not able to raise the invoice on March 31st due to issues in the billing system. So they raised the invoice, let's say, only on April 1st. So on March 31, 2025, that is for the financial year 24-25, they did not raise the invoice for the 5 lakh which they were supposed to raise due to issues in the system. So what would happen? The second entry would not have been passed in financial year 24-25. It would have been passed in financial year 25-26. Am I right? Yes, sir. You are right, sir. So this entry would be passed in financial year 25-26 when the invoice is raised. In that scenario, only the first entry would have been passed, which is basically contract asset debit to revenue to the extent of 248,618. So in that scenario, what would happen? Your revenue would go to P&L. But where would this contract asset be present in the financials, sir? This contract asset would be shown under trade receivables. Trade receivables? What's up? You have not raised an invoice. How can we show it under trade receivables? Guys, this is where Ind AS 115 tells you that if you have an unconditional right to receive the amount, you should show that contract asset under trade receivables. We have an unconditional right to receive the amount. The reason being that we have the right to bill 5 lakhs as on 31st March. But we did not raise the invoice due to administrative reasons. That is the only thing. So it is just because of administrative reasons that we did not raise the invoice. Since we have the right to raise the invoice to the extent of 5 lakhs and the revenue, unbilled revenue is only 2 lakh 48,618, we take the unbilled revenue to trade receivables, and as a part of Schedule 3 aging, we show it under unbilled column in our Schedule 3 aging. I hope that is very clear, guys. Next, let's take the third scenario. Let's say in our engagement letter, we agree that the entire 30 lakhs invoice should be raised only on completing the audit, that is on 30th September. Then what would happen is, then the contract asset would not go to trade receivables. It would be grouped under other contract assets because on March 31st, you do not have the right to invoice to the extent of 5 lakhs, sir, in the third scenario. So you cannot recognize it under trade receivables. It is only other current asset under which you should be recognizing. So in second and third scenario, there is no difference in the entry flow, guys. It is only a difference in the presentation of the contract asset. Right? I hope that is very clear, guys. Now let's take some real life annual report steps of Big Fours and correlate with what we have seen now, guys. You will get tremendous clarity after doing this, I assure you. And these annual report links I've attached it in the description. I've also attached it in the pinned comment, and you can also find the PDFs of these annual reports in my Telegram group, and you can check it out from that. You can check it out from any of these places, and you will find crystal clear clarity, guys. I assure you, crystal clear clarity. So let's just go into this. So I've taken Deloitte Netherlands annual report. So I'm just reading the highlighted parts, guys, because as you're aware, every Big Four firm has multiple streams of revenue. We just took Stat Audit Revenue as a stream for discussion today. We'll just read the points in relation to Stat Audit Revenue accounting policy, right, and not the other ones. For fixed fee arrangements, the group uses an input method based upon the value of services determined based upon the number of hours charged in the undiscounted hourly rates, which is what we discussed. I hope that is clear. Charged to the engagement to date compared to the total expected inputs. Chargeable time for employees tend to be the most significant input and this is charged to individual contracts and performance obligations via timesheet reporting. Yes, sir, I told you the concept of timesheet reporting. You're able to recollect that? Yes. Revenues are recognized as employee time is used to provide the services. Very clear? Yes, sir, perfectly clear. The next few points are not in relation to your stat audit services, so I'm just ignoring that. You can read that out of personal interest if you want to, as I'm already giving you the links to the annual reports. Next, PwC UK. So, what does this say? Let's just see this. Just a moment. Fixed fee contracts Fixed fee contracts are recognized over time based on the actual services provided to the end of the reporting period as a proportion of the total services to be provided, where there is an enforceable right to payment for performance completed to date. This is determined based on the actual inputs at the time and expenses related to total expected inputs. The same thing. There should be an enforceable right to payment, and this should be based on percentage of completion, which is what they are saying. Right? I hope that is clear. Next, let's come to KPMG UK. And guys, I just forgot to tell you. So, as I told you earlier, every audit firm will also be audited. So, Deloitte Netherlands, I was not able to find the audit report. I was just able to find the financials. PwC UK, if you see, it is audited by an audit firm called Crowe UK LLP. you can just see the audit report also, which I've attached. You'll get an understanding. And similarly, if you just come to KPMG UK, KPMG UK is audited by Grant Thornton, which is again an audit firm. Next, if I just come down below to KPMG UK's annual report. So what are they saying? Similarly, revenue derived from fixed fee contracts is recognized over time, and it should be recognized when there is an enforceable right to payment over a period of time. I hope that is very clear. Same thing which is stated in PwC's annual report. But there is one point which they have explained in a very beautiful way in relation to contract asset and contract liability, which I wish to discuss with you. So, when revenue recognized by the UK group and partnership exceeds the amounts invoiced, a contract asset is recognized within trade and other receivables. This is what we discussed. Consideration received or amounts due in excess of revenue recognized by the UK group and partnership are classified as contract liabilities. Yes, this is what we discussed, sir. Because when we are supposed to recognize a revenue of 100, but we have billing an amount of 120, the excess of 20 has to be recognized as a contract liability. Very clear, sir. Within trade and other payables. Yes, sir. It should be ideally going to other current liabilities. Next, contract assets are reclassified as trade receivables when invoiced or when the consideration becomes unconditional. Very, very, very important, sir. Only when the passage of time is required before the payment is due. This is what we discussed. When there is an unconditional right to receive the same, you have to recognize the revenue. You have to recognize the same in trade receivables and not other current assets. However, when there is a conditional right to receive the amount, it should be recognized in the other current assets. I hope that is very, very, very clear, sir. Next, coming to EY Professional Services Limited. Again, EY, an audit firm, is audited by another audit firm, BDO, which is again an audit firm. So, just coming down below, guys. So, guys, this is more or less similar to what is there in KPMG's annual report. I'm not again reading that. If you can read that out of your personal interest. Just one more point which was good actually in this, which is very, very clearly elucidated here. I just want to go down to that. Significant estimates. The effect of making different assessments could in aggregate have a material effect on the carrying amounts of unbilled receivables and slash or payments on account of which are shown in notes 13 and 14 respectively. Obviously, as I told you earlier, instead of 8 point something percentage which we got via percentage of completion, if 10% had been used, the revenue number would have been increased and your unbilled receivable number would also be increased. So this sensitivity and this professional judgment involved would trigger trigger a slight change in the numbers of revenue and unbilled receivables because there is a degree of professional judgment involved because the rate charge out is based on professional judgment. The rate charge out is based on management's estimate. Since an estimate is involved, there is a possibility of sensitivity here. I hope that is very clear, guys. And guys, I hope you found this session very, very insightful. I hope you learned something new. Thank you so much for hanging on till here. Keep learning, keep growing. And if you want any specific video or anything in relation to Ind AS 115, any doubts, do comment that down below and I will respond to you right away. Thank you so much, guys. If you hung in till here, keep learning, keep growing. Wishing you all the very best in all your endeavors. Thank you so much. Cheers. Thank you.